First of all, thanks a lot for having me, Marty, and I appreciate the opportunity to share some of my views with all of you today. Just a little background on me. I came out of the capital markets industry. I worked on Wall Street for 30 years. I'm a retired hedge fund manager. Started my own family office known as JWH Investment Partners about 4 years ago. And in that process decided, due to a lot of demand from former clients and former investors in my prior macro fund, people were interested in my views. So I began publishing my investment views and basically started a research boutique, an independent research boutique called Alpha Insights. And so we've got about 70 institutional investors that pay us on a quarterly basis for our views, and lots of family offices. And we could talk about any deals that you guys might want if you wanted to participate and get some access to our work. But the bottom line is we focus on global macro, and our view is really to look at the top-down economic situation from a global standpoint and try and determine what the implications for equity markets, fixed income markets, commodity markets, rates markets are, and then what to do about it. And so that's really what I'd like to cover today. I think what I'd really like to do is share my screen and my presentation with you all. And let's see if I can master the technology here. Boom. I think this is what I'm looking for. And we're not quite on the right page. There we go. And let's see if we can tee this up. There we go. Hopefully you can see this presentation. So let's start out.
Good.
Good. Let's just start out with a quote from Seth Klarman, the value investor of Baupost Group fame. It is only in a bear market that the value investing discipline becomes especially important, because value investing virtually alone among strategies gives you exposure to the upside with limited downside risk. And I think in this particular environment, those words are sage. First of all, we have to consider what's going on in the real economy. Real GDP growth is slowing. We just came off the best year that we've seen since 1984. Real GDP growth in 2021 was up 5.7%. That's a 37-year high. And the fourth quarter was running especially hot at an annualized rate of around 7%. Today, the first quarter looks poised, according to the Atlanta Fed's GDP nowcast, to come in at less than 1% on an annualized rate. Now, generally speaking, the first quarter is the slowest quarter of the year, but sub 1% GDP growth is unusual, to say the least. Next, let's look at inflation. Core inflation is rising. There's no question about it. Across the board, of the 9 measures that the Federal Reserve banks calculate on a year-over-year basis, core inflation now grossly exceeds the Fed's 2% target rate by around 300 basis points today. And depending what you want to look to for the drivers, anything from rising used car prices to housing prices to rent, to the price of oil, which is a very large component, to agricultural commodities, across the board, we are seeing increases in inflation that we have not seen in at least 30 and possibly 40 years. So the real question then is, what does this translate into from a geopolitical perspective? Well, the Fed keeps its own geopolitical risk index, and that index is at a very high level, the highest level it's been since 2005, when the London bombings occurred. And the problem with this is that it may actually influence the Fed's ability to tighten monetary policy and control that inflation. One of the things that's driving inflation right now is commodity prices. The CRB index, which is comprised of around 19 of the most liquid commodity futures contracts, and about 39% of that is allocated to energy, 41% to ag, has seen a big breakout. We saw, no doubt, probably a generational low during the pandemic in March of 2020, and in early April of 2020, oil futures actually went negative for the first time in history. So what we know is most likely the energy markets have bottomed. And if we're looking at the March 2020 lows in commodities as being a low, then we have broken out above trend resistance, above chart resistance, and above the long-term historic mean looking back to 1969. But if you look at the lower frame of this chart, it actually evaluates the structural momentum of that trend. And structural momentum is actually broken out above a 50-year downtrend line. So this leads to the conclusion that this change, this radical trend change in commodity prices looks sustainable and looks to have very strong momentum in both the short term and the intermediate term, meaning looking out at least 1 year. Fed policy is tightening. If you look at the dot plot, which is on the right-hand side of this chart, you can see that for 2022, the vast majority of Fed governors expect just 3 25 basis point hikes this year. The next of which should come Wednesday afternoon, tomorrow. So we'll hear from the Fed, and we'll hear as to what in fact they think of the inflation outlook going forward. Well, based on the survey done by CME Group, about 95% of those institutional and economists that have been surveyed believe that the Fed will raise by 25 basis points. There's an outlier, about 5%, who are no longer even looking for a rate hike. And this is largely because of the military conflict going on in Eastern Europe right now, and the sanctions being brought against Russia, and the fact that oil production can't ramp up fast enough to compensate for pulling Russia's exports off the market. And so, basically you're talking about 8 million barrels a day, 3 million of which go to the West. And can we ramp up 3 million barrels of production fast enough in order to stabilize the market? And the Fed probably at this point is suggesting no, by the simple fact that we're going to probably see a 25 basis point hike tomorrow, as opposed to something greater and far less aggressive talk by Greenspan and company. I'm sorry, by Jerome Powell and company. I date myself, right? So at the end of the day, I think we can expect Fed policy to be somewhat less tight than a lot of people had been anticipating as recently as just 3 weeks ago. And that could be a difficult situation for the global economy and the inflation environment at large. 10-year Treasury yields are rising. The bullish inflection that we saw earlier this year above the 1.8% level, actually, if that's sustained from a technical perspective, it projects a measured move to approximately 3%. And if you take a look at the left-hand side of this chart, you can see that the decline from around 3% back in 2018, below 2%, took just 9 months. And so this breakout actually has the potential to resolve up to that 3% target within the next 9 months, which to me suggests there's a high probability that we could be looking at 10-year Treasury yields of 3% or greater by the end of this year. So what are the implications of that for global debt and global assets at large? Well, actually, let's start with equities. If we increase 10-year Treasury yields to 3%, that is going to put a lot of pressure on PE multiples, especially for growth stocks like Apple and Google. We would expect that to compress PE multiples substantially before year end. With respect to global debt, which is soaring, and this chart actually came from the Financial Times. It was published back on just after the end of the third quarter, where various entities, the International Association of Finance, the BIS, International Monetary Fund, and a variety of other national sources comes up with this figure of about $295 trillion in global debt right now. That includes sovereign debt, corporate debt, and consumer debt. And what we see is, this has the potential to impair balance sheets because the holders of that debt are going to see the value of that debt decline substantially if in fact rates do rise to that 3% level that is targeted.
Hey, Jeff, can I jump in 1 second?
Absolutely.
So can you go back to the prior slide? So you're talking about, so what percent of this debt is dollar denominated?
This is 100% dollar denominated.
So $295 trillion of dollar denominated debt worldwide, and we're slowing down the issuance of dollars?
Yeah, that's a concern, obviously. This analysis doesn't take that into consideration even.
Right. I mean, we saw this with Latin America in the 70s, right?
Indeed.
But it's worldwide.
It's worldwide. And so all we've done is we've taken global debt, we've denominated it in dollars. We've come up with a level that is just epic relative to history and where we see rates going. Think about where rates went out last Friday at 2%. To go to 3% is a 50% increase in the 10-year bond yield. Everything is priced off the 10-year bond yield. And so you're going to see a rather epic impairment of balance sheets as a result, because this debt is held by investors, it's held by financial institutions. Frankly, if rates go up, I mean, all of your real estate investors are going to feel it as well, because cap rates in Austin, Texas right now are about 3% on residential projects, multifamily projects. And I would suspect that if rates go to 3%, those multiples will probably go to around a 5 or 6% cap rate by the end of the year. So that doesn't look too interesting to me.
Can I ask one question on, so this red line, which is the GDP ratio, is the pandemic effect, right? We have a 20% greater loading in terms of percentage GDP starting the pandemic, and now it's coming down. Do you have a prediction around that?
I don't have a prediction. I'm more of a data analyst than a forecaster, so to speak. But what we have seen is GDP rally back off of its pandemic lows, right? And so the debt as a percent of GDP has come back down. But it is dramatically higher than it has been historically. In fact, take a look at Japan, which is one of the largest debtors, and they were about 200% debt to GDP. Here we are globally at around 350 or greater percent of debt to GDP. So it's off the charts for all practical purposes.
Jeff, do you have any numbers on the amount of U.S. issued securities used by central banks around the world as reserves?
Well, I can tell you that the number's around 50 trillion in U.S. issued securities, and the vast majority of sovereign, about 50% of U.S. sovereign debt is held by foreign entities, the largest of which is China.
Yeah, I'm not so concerned about the sovereign debt as much as I'm concerned about like CDOs or things like that.
Yeah, well, you're talking about the derivatives market. I mean, the notional value of derivatives is, perhaps another 600 trillion on top of the actual debt itself. So we could be talking about numbers that are, really unfathomable.
Okay, keep on going.
Yeah. So let's take a look at what the implications are for the stock market at this point. After posting a negative divergence in late 2021, the momentum of the market, the structural momentum of the market, which really just looks at the positive deviation above its 36-month exponential moving average, turned down. Now, that is generally a precursor to a trend change in equity markets, and it tends to lead by about 6 months or so. Well, in fact, we didn't get that 6-month lead time. It lasted about 6 days. The first week of 2022 is when equity markets across the board topped, at least the major averages. The S&P topped on the 4th of January, the Dow on the 5th of January. And in fact, we've seen a sharp turn down from peak to trough, about a 14.5% drawdown in equity markets in the US. And momentum has tanked effectively. But what's more important is we've overlaid a 7-year cycle on this. And, cycles are much easier to discern when you look at them through the lens of momentum. And what we see today is that the 7-year cycle is coming to a close this year, and that momentum probably won't bottom until the end of the cycle, which will be around September 30th of this year. So we've got about 7 more months of downward momentum in the market to look forward to if history is any guide. The other big issue in the market that has been painfully obvious to anyone who's owned small caps and mid cap stocks or emerging growth stocks is that the market's breadth has collapsed. We actually saw the Russell 2000 small cap index peak back in late February of 2021, and it has been going down ever since. Meanwhile, large cap averages like the S&P and the Dow have made new highs. But if you take a look at the NASDAQ composite index and the NYSE composite indexes, and you look at their cumulative advanced decline lines, those advanced decline lines peaked many, many months ago. In fact, the NASDAQ peaked in July, actually peaked, I believe, in March, put up a double top in July and made a much lower low in November when the NYSE actually topped. And what we've seen since that is a negative divergence in both of these, which again preceded the top in the market and is leading it lower. So the average stock is making a lower low as of Friday. And what that tells us is that the infantry has left the battlefield and there's just the generals left climbing the hill, leading the charge. Eventually, those large cap indexes will fail just under their own weight. And that's
are there, Jeff, are there a few companies who are really carrying the day and keeping the indexes afloat?
Absolutely. I'll give you one example.
Google,
Berkshire Hathaway.
Apple.
Berkshire Hathaway made a new all-time record high this morning. And so, it happens to be the largest financial stock, even though it's a conglomerate in the S&P 500. I believe it's the 8th largest stock by market cap in the S&P 500. But stocks like Apple and Google and Amazon and Facebook and NVIDIA and Tesla, those stocks are getting creamed.
They're going to start taking oil and natural gas over the railroads instead of the pipelines.
They certainly have the balance sheet to do so.
Keep on going.
Yeah. So another concern is net positioning is now near a record long position. So, normally when we look at net positioning by futures traders, when the market is making a low, futures traders are typically short. They typically are trend followers, right? And even though we've seen investor sentiment come down dramatically, surveys such as the NAME Exposure Index and the AAII Individual Investor Survey, and even the Institutional Advisors surveys are all looking like they're near their March 2020 lows, that pessimism persists across the board. Fear is running rampant, right? Meanwhile, these speculative large futures traders are all in, and the market's only down about 14%. Normally, they would be short. So this is not at all consistent with past market bottoms, which leads me to believe that this is more likely an intermediate term low that could then see some sort of a bounce, but then follow through to the downside dramatically.
And you're saying that's going to be in the next 6 to 7 months?
I think this year. I think by the end of this year, we'll have a lot more information about it. And the next few charts will help you understand where I'm going. So S&P sector leadership is narrowed dramatically. You mentioned energy. Energy is the only GICS sector in the S&P 500 that is in an established uptrend. It's leading, it's up and to the right. Every other sector is now negative and pointed straight down. We threw in gold miners here, which are not part of the S&P 500 with the exception of Newmont Mining, but gold miners are making a strong rally attempt as well here. And so, we think energy and gold miners are really the only two sectors that look attractive right now within the broad swath of US equity markets, or North American, if you will. Our trend analysis turned bearish on Friday when the S&P 500 posted a weekly close below 4,300, or more specifically, S&P 4278, which was the October 4th low. And by taking out that October low, we've really set up what I would define as kind of a classic pattern top formation of the head and shoulders variety. And that top actually counts down to around 3,800 on the S&P 500 in the immediate future. So that would be my very short-term target for the S&P.
And that's purely a technical analysis sort of viewpoint.
Purely technical analysis. Yep. And one of the reasons I'm not putting any fundamental ideas out there like earnings estimates and PE multiples is because what's happening right now, especially with GDP growth going down, is we're seeing earnings revisions come in to the downside by and large. That's the first time in 6 quarters that we've seen earnings revisions going down. And so, we have been used to seeing earnings revisions to the upside. We came into the year looking at 9.5% EPS growth on a consensus basis. We're now at about 8.5%. So even though that doesn't sound like a big revision to the downside, it's about a 12, 13% decline in earnings growth. And so my suspicion is we're just seeing the beginning of that. They usually don't start, down 100 basis points and then reverse back up, right? It's usually several rounds of revisions to the downside before we get to where analysts bottom out. They tend to be late to the party, if you will. We do something a little bit more detailed known as Elliott wave analysis, where we take a look at actually the short-term swings as well as the long-term swings in the evolution of the advance itself. And if we look on the right-hand side of the chart, we've kind of blown up the last 2 years. This is the move from the March 2020 lows at the end of the pandemic to the highs of January and where we are today. Now, we would define that as primary wave 5. Primary wave 5 within cycle wave 5, and cycle wave 5 is on the left-hand side of the chart. And that wave really looks at the entire 13-year advance off the March 2009 lows to present. And what we see at this point, based on the breakdown below the October 4th low, is that we are now in a defined downtrend, and it confirms that we actually topped in terms of cycle wave 5 on January 4th. If in fact that analysis is correct, and we'll only know with time if we continue to trend lower, then we're at the precipice of a third wave decline, which could be not just swift, but broad and could catch a lot of people off guard. So we would
expect 5 minutes, Jeff.
Sorry?
5 minutes.
So we'd expect this would catch a lot of people off guard, and it'd be a swift move down to around 3,800. Now, on the left-hand side of the chart, we indicate that, to correct the entire advance off the 2009 low, it might take something more substantial, like a 61.8% retracement of the entire advance, which would bring us all the way back down to around the March 2020 lows of around 2,200. Importantly, if we look at the next chart, it brings into question whether or not these cycles actually could be representative of a much larger degree cycle. Elliott wave principle is based on the notion of fractal geometry, where there are self-similar wave formations of 1, 2, 3, 4, 5 motive type and ABC corrective type at every single degree of trend. So if we assume that a super cycle exists and no one's actually seen one because there's only 130 years of stock market data that's reliable, but assume that one began back in the late 1800s, and we saw the peak of super cycle wave 1 in 1929 and the trough of super cycle wave 2 in 1932, then we've got a 5-wave advance that actually peaked in 2022 in January, and that could very well be super cycle wave 3. Now, if in fact we had to correct that proportionally, it could take us all the way back down to the parallel trend channel boundary, which is near the cycle wave 4 low. I'm not predicting this. I'm simply saying that this is a possibility that we need to be aware of. So since I'm running out of time here, I just want to throw out some ideas for you. In this market environment, to me, you're kind of looking back on Seth Klarman's view of value investing, it's clear to me that value versus growth is breaking out. Here we're looking at a ratio of pure value to pure growth. And we've seen that ratio put in a double bottom over the last 2 years, and it has now broke out above trend resistance, moving average resistance, and chart resistance to make really a convincing breakout high that counts up about 1,500 basis points in absolute return. In other words, if you're long value, short growth, you can make 1,500 basis points of return on your money and have zero market exposure. What gives me the most confidence in this is that the momentum study at the bottom of the chart broke out to a new all-time record high. And that speaks to the intensity of this breakout. So in our opinion, being long value and being short growth might be the best place to hide right now. But there's one other place that I would look to. And let me talk about that after I talk about the correlation here. This ratio is highly correlated to rates. And if in fact 10-year treasury rates do make the move to 3% as we suspect, then we should expect this ratio to move right in the same direction rates do, much, much higher, especially because those higher rates are going to compress multiples on growth stocks more than value stocks. Final idea I want to throw out there is gold. Maybe the best place to hide of all would be simply to have a very large allocation toward gold. The breakout that we've just witnessed here above $2,000 an ounce, and even though we've pulled back somewhat, actually projects a move up to around $2,500 an ounce. And if you look back at past bear markets, gold has been kind of a safe haven asset class that has outperformed in substantial declines. In fact, even if we look at 2008, when the market was down over 38%, gold was flat. It didn't go down. And if we look at it from the entire peak trough decline, gold was actually positive by 8%.
Jeff, is this physical or paper gold?
Well, I'm just using the physical gold, so the spot price of gold bullion to make that calculation. But this really looks like a compelling chart to me. Momentum is breaking out as well. It's early stage, and so it tells me that we're just getting started here. And if gold breaks out above 2,500, I can come up with a target price of 6,000 for gold, just using pure technical analysis. And since really there are no earnings from gold, there's no other way really to analyze why someone would buy gold. It's an insurance policy. It's something people do to protect their capital against inflation and also deflation. So it's a safe haven asset.
Jeff, do you have anything in here about crypto?
I do not. But I do have my contact information. If anybody wants to reach out and learn more about some of the work that we're doing, you're more than welcome to try and follow me on Twitter or send me an email or go to my website. There's lots of great information there about the work that we're doing as well.